Hello and welcome to 2023 Investment Outlook brought to you by Magpie Securities. I'm Anthony, Magpie Invest Strategist. In 2022, we have seen a bad year for traditional asset classes with heavy losses in equity markets amid threats of a global recession and rampant inflation. Bond prices have also fallen on aggressive central bank tightening to contain inflation. As we head to 2023, we expect the market volatility to remain elevated as threats of rising inflation and central bank monetary tightening will stay around. That said, we're of the opinion that 2023 will be a year of recovery for countries and companies that have strong fundamentals and attractive valuations. Following the sharp declines in 2022, we have become more positive on the equity markets, with a slight overweight position in the asset class. For the fixed income market, however, our neutral stance is due to the different impacts on investment-grade credit and high-yield bonds amid the uncertain economic environment. We're overweight China equities because of the country's stronger economic performance and more attractive valuations. China, the world's second-largest economy, is expected to outperform the rest of the world in terms of real GDP growth in 2023. The higher growth is a result of the country's dual circulation economic strategy, which was introduced in late 2020. The strategy involves prioritizing domestic innovation while remaining open to international trade and investment. On the other hand, the US's protectionist policies have seen some parts of corporate America suffer. The overall results can be seen in the divergence in corporate earnings growth. China's corporate earnings growth is expected to outperform the US and Europe in 2023, largely because of the country's resilient domestic demand. The well-contained coronavirus situation has also helped the country's economic activity continue to thrive. Not at all. China equities are valued attractively indeed. The MSCI China and Hang Seng indices are trading at much steeper discounts to the historical price-to-earnings average as compared to the US and Europe. Monetary easing during the pandemic has helped keep American consumer wallets stable. On the flip side, however, record-high inflation kicked in during 2022. This, together with the Fed's tightening monetary policy to contain inflation, has put the US economy on the verge of a severe recession. The upcoming recession that is expected in 2023 can also be seen in the inverted US yield curve, which is a traditional indicator used by economists to predict a recession. The gap between short and long-term US borrowing costs has reached its widest point since 1981. The situation in Europe is even more miserable. Recession is highly probable over the winter, as inflation is expected to drag on for longer than initially expected, as high energy bills will prolong inflation in Europe. While the US and Europe are suffering from record inflation, China's inflation is just around 2.1%. This means that the People's Bank of China still has room to roll out monetary easing policies to stimulate the economy. This is not the only reason for our overweight position in China. While the West has already been living with the virus, China has just started moving away from its mass testing and quarantine requirements and is reducing the use of health code system, which suggests more growth potential down the road. We're expecting a much larger upside potential in China equities than the US and European market. And the upside could be even more if China reopens its borders to international travelers in 2023. It's too simplistic just to name some sectors. But if we look at the history of the US market, for example, consumer staples, materials, healthcare, energy, and utilities tend to outperform during periods of economic contraction. In my opinion, investors need to be selective. They should look for companies that are already producing reliable profit streams and with lower debt levels. These include some traditional energy companies, selected telecom and technology stocks, as well as industrials that have strong business moats. The answer is yes and no. Bonds are an obvious casualty of rising inflation. Their fixed stream of interest payments becomes less valuable as inflation accelerates. sending yields higher and bond prices lower to compensate. On the other hand, as investors were worried about slowing growth and high inflation in 2022, many of them avoided assets that only have profits in the future, and therefore resulting in a positive and high correlation between equities and bonds. This can be seen in the hand-in-hand decline in equities and bonds in 2020 when central banks started raising interest rates. Heading into 2023, if the Fed manages to stem up inflation by really crushing aggregate demand, then we're going to see high unemployment, in which case the Fed may reverse its monetary tightening policy. Such a scenario will be positive for quality bonds such as US Treasuries and investment-grade bonds. If the US economy does go into recession, then more American companies will suffer and default on their borrowings. That will inevitably be hurting the price of high-yield bonds. It all depends on US inflation. Since the Fed has raised its main policy rate to about 4% so far this year, US inflation has decelerated from its 9.1% peak in June to 7.1% in November. So it would not be surprising to see the Fed retreat from the 75 basis point increases. In terms of risk consideration, first of all, there's a very good chance that the Fed is going to push the economy into a hard recession. With that potential outcome in mind, investors need to remain very vigilant. Secondly, if China reopens further, that could put more upward pressure on energy prices, which may prolong the Fed's and other central banks' battle against inflation. Thank you for watching. I hope you enjoyed the video. See you next time.